Welcome to Spidell's California Minute. I'm your host, Catherine Zidane, and this week we're covering some year-end tax planning tips for individuals and businesses. We covered this topic in greater detail in the December 2021 issue of Spidell's Federal Tax Letter. For subscription information and a sample issue, go to caltax.com and click on Publications. In another year of tax turmoil, we're left with more questions than answers about what could happen in 2022. With the President's Build Back Better Act on the ropes right now, it appears that high-income individuals would be the most affected. This is generating a rush to sell, gift, and estate plan. Here are a few of the tried-and-true planning techniques to consider in the final days of the year. We know to take losses at the end of the year. For clients with publicly traded partnerships, you can sell one publicly traded partnership at a loss, free up any suspended losses, and replace it with another publicly traded partnership that's similar. There will be some capital gain and ordinary income on the disposition, but all the suspended losses from that publicly traded partnership will be freed up. If you don't repurchase the same publicly traded partnership, you won't run afoul of the wash sale rules. Remember, you can't offset losses of other passive income with the loss on the disposition of the publicly traded partnership. Regarding charitable contributions for 2021, you can contribute up to 100% of AGI in cash charitable contributions. Also, we've always been a fan of donor-advised funds. Consider contributing appreciated stock to a donor-advised fund. You get a 100% fair market deduction, and you can immediately repurchase the stock in your own account, which resets your basis. Of course, if you want to contribute stock with a loss, sell the stock first, take the loss, and then contribute the proceeds of the sale. Consider these tax planning options for businesses. Plan wage payments to children who work in the business to keep them under the filing requirement. Pay a spouse wages to include the spouse on the company retirement plan or to build Social Security quarters for the spouse. Adjust bonuses and final paychecks to reduce or minimize tax, including the 0.9% additional Medicare tax if the client is near the threshold. Give your clients an accounting policy that's updated to reflect the $2,500 de minimis election amount. The election must be in place at the beginning of the applicable tax year, and the policy has to actually be followed for financial statement purposes. And last, maximize repair expenses by taking advantage of the safe harbor for small taxpayers with buildings. A landlord or a business can elect to expense certain costs that would otherwise need to be capitalized up to $10,000. Split multiple projects at the same property over 2 years to avoid capitalizing the expenditures. And last, taxpayers who are owners of pass-through entities like partnerships, S corporations, and LLCs taxed as partnerships or S corporations should consider whether they can elect to make pass-through entity tax payments pursuant to IRS Notice 2020-75. It's important to note that the most current version of the Build Back Better Act contains an increase of the SALT cap to $80,000. If the Build Back Better Act passes in its most current form, the increased SALT cap will eliminate the benefit of the SALT cap workaround for the vast majority of taxpayers. If you still need to register for an annual tax update, our federal and California tax update webinar runs through the end of January. You can see available dates and get a list of topics covered at caltax.com under the webinars tab. That's all for this week. Join us next time for another installment of Spidell's California Minute.